Hey everyone, welcome back to Corporate Decoder. Today, Overland Advantage just filed a current report detailing an amendment to their credit facility, and I am seeing moves that change their borrowing costs and flexibility. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about tweaking the terms of their big debt agreement, and it looks like they are getting a slightly better deal on borrowing, but there are some important limits being tightened. So, we are looking at Overland Advantage, and they have made some significant changes to a major loan agreement. Think of this as a refresh on how they borrow money to run their business. Specifically, they entered into what they call the Fourth Amendment to their loan and servicing agreement. This is for their revolving credit facility, which is basically a flexible loan they can draw from. Back in February of 2024, they set this up and it has been adjusted a few times since then. The latest date for this amendment is the 2nd of July 2026. The key players here are Overland Financing MS LLC as the company borrowing money, Overland Advantage itself acting as a servicer, and Morgan Stanley as the main bank involved. Now let's break down what these changes actually mean for the company. The biggest news is about the timeline for their borrowing. The period where lenders are committed to let the company borrow money, which is called the revolving period, has been extended. It was set to end in February 2027, but now it will go all the way to July 2028. On top of that, the final payoff date, or the stated maturity for this entire credit facility, has been pushed back from February 2029 to July 2030. This gives the company more time to manage its debt. But it is not all good news. They have also removed some exceptions related to specific types of loans called recurring revenue loans. This means the company has less flexibility and might not be able to invest as much in these particular types of loans as before. Think of it as the bank saying, we are giving you more time, but be a bit more careful about where you put that money. Here is where it gets financially interesting. Overland Advantage is getting a break on interest rates. During the period when they can borrow money, the interest rate has dropped. It used to be the benchmark rate, which is currently a SOFR-based rate, plus 2.35%. Now it is the benchmark rate plus only 1.95%. That is a reduction of 0.40%, which can add up to significant savings, especially on a large loan. Even after the revolving period ends, when they are expected to be paying down the loan more steadily, the interest rate has also decreased. It went from the benchmark plus 2.85% down to the benchmark plus 2.45%. So, no matter when they are borrowing, the cost of that money has gone down, which is a positive sign for managing their expenses. They are also paying less for the money they are not even using. This is called an unused fee. It has dropped from 0.50% per year to 0.40% per year of the total amount they are allowed to borrow but haven't drawn down. This is another cost-saving measure. Now, let us talk about how the company has to prove it is financially healthy. There is a specific rule called a financial covenant that requires them to have a certain amount of liquid cash on hand. This was previously set at the greater of $25 million or 7.5% of their total debt. The amendment changes this requirement to now be the greater of $30 million or 7.5% of their total debt. So they need to maintain a higher cash cushion, which is a sign that the lenders want to ensure the company has enough readily available funds to cover unexpected expenses. On the flip side, they have also increased the limits on certain types of loans they can hold, specifically second lien loans and FLO loans. This percentage limit has gone up from 15% to 25%. This suggests that while they have been restricted on recurring revenue loans, they have been given more room to invest in these other types of loans. This could indicate a strategic shift in their lending portfolio, or simply an adjustment to better match their risk appetite or market opportunities. Overall, this looks like a strategic move by Overland Advantage to secure more favorable borrowing terms and extend their financing runway. The lower interest rates and extended maturity dates are definitely good news for their financial management. However, the tightening of restrictions on certain loan types is something to watch closely. It could signal a move towards different investment areas or simply a way for the lenders to manage their overall risk exposure. Alright, that is my take on this amendment. What do you think these changes mean for Overland Advantage and its future borrowing strategy? Let me know in the comments below. If you found this breakdown helpful, please hit the like button and subscribe for more corporate filings decoded. The research tools I use for these analyses are linked in the description below. That is my take. Stay decoded, and don't forget to like, subscribe, and join our Discord community linked in the description.